Okay, there we go. We'll welcome everyone to the latest Together for Business webinar. I'm Damon Scott, as the slide says, Chief Executive of the Dunbartonshire Chamber of Commerce. So thank you for joining us in the latest of our knowledge transfer events. I'll have to just do, we've got lots of familiar faces, but I do know we have a few newcomers as well. So just before we kick off, just to let you guys know a little bit about the Together for Business initiative. So we set this up at the start of the crisis in response to, obviously the Chamber was very active in terms of events and connecting businesses and providing support. So we didn't want to lose that, and obviously with the situation most businesses found themselves in, we were needed even more to provide a bit of support, and I mean, particularly at that time, to communicate information about grants, about HR, you know, the legal situation with a lot of businesses, and providing the support and information they needed in the short term. We also set up a Together for Business hub, which you can find on our website, where we were putting all the up-to-date information, and that's developed over time. What we've found more recently is that the sort of conversations and the needs of business have changed a bit. So moved from the initial sort of reactive situation to now looking at the re-emerging economy, and this is the latest in our series of webinars to try and respond to that, to help to prepare businesses to get back to business. So last week we had a planning workshop, and this was the ideal follow-up to that in terms of the financial planning part of that. I was just having a conversation just before this, actually, to say, you know, if you know, the three things I think you need as a business are a corporate plan, and part of that is, you know, the other two parts of that that are really crucial: your financial plan and your marketing plan, you know, to actually communicate to your audiences. So if you've got those three things in place, you've got a really solid foundation. Hence why we've arranged this follow-up with Paul to the meeting last week. Just before we proceed, I'll just do a wee bit of housekeeping. So most people are used to Zoom, but the way we tend to run the sessions is you'll have a menu bar either at the top or bottom, I think, depending on what device. Normally at the bottom if you've got a laptop. You can click on the chat, and there'll be lots of information going up in the chat bar throughout. And you can also click on participants as well. That gives you the option to raise a little blue hand if you want to ask a question. I think Paul will explain a little bit more, but we'll be asking the questions towards the end of the session after Paul's presented, and I think there's an opportunity to put any questions into the chat, and we'll pick those up at the end as well. I know we've had one or two sent in prior to the event as well. So that's really it from me. Anything else I've missed there, Philip, that I need to mention now? No? Okay, that's great. So without further ado, I'll pass over to Paul, who's going to present today's session on financial planning, and Paul is the founder of Kingsmith Property Group, and has many years experience as a chartered accountant and finance director, so ideally placed to present this particular session. So over to you, Paul.
Thank you, Damon, and welcome. And yes, thank you for giving me the opportunity to present on this subject of financial planning. Hopefully today we'll be able to cover a bit of advice and make it as practical as possible so that people can see some benefit from today's talk. Before we get into the detail, though, I'd quite just like to introduce myself for those people that don't know me. Paul Kingham. I qualified as a chartered accountant 25 years ago, which I hate to think about. It seems like forever. I qualified in a small firm of accountants in Glenrothes in Fife, which for Fife terms was quite a large firm of accountants, and therefore that gave me a great experience in terms of the range of clients that I worked with and the size of them. So it was a fantastic opportunity to get a good training in my sort of cut my teeth in accountancy. And then I moved on to work in another few accountancy firms doing in general practice for probably the best part of 10 years, doing all the sort of stuff that accountants do: audits, tax, financial planning, accounts, etc. And then I moved into the NHS, where I was I had a number of roles in the NHS, but my primary role was a principal finance manager. And that was an excellent opportunity to get the sort of corporate feel of how finances are run. I've gone from managing or working with clients of maybe £10 million up to an organisation of 600 million with 3,000 staff and the various systems and processes that are involved with that. I also worked for the Scottish Housing Regulator as Head of Planning and Performance, and that exposed me to other areas in terms of things like risk management, project planning, and the various things in terms of not just the financial aspects of measuring how a business is doing, but the whole sort of performance management side of it. And ultimately, all these transferable skills that I've got in project management and financial planning have been absolutely paramount to setting up Kingsmith Property Group, our financial, our property management business. So that's a bit about me. I'd like to run a quick poll now. So I think Philip's going to run this poll. It's just so that I can get an idea of what everybody's background is on the call today. I think there's probably, how many people have we got on the call? Got 19 people on the call. So if you could just take 30 seconds to fill out these questions, it gives me an idea of where folk are coming from. It's very eerie doing a webinar where there's total silence in the background, everybody's on mute, so hopefully we'll manage to get through these questions. Okay, Philip, I'll let you gauge when you can close that poll.
I was just going to give it another 10 seconds or so.
Yeah, that's fine. That's fine.
I think people are still putting in some information.
Yeah, it's just a yes/no answer, so it shouldn't really take much more than 30, 40 seconds to do that.
Right, if everyone's ready, I'll end the poll now. And do you want to share the results, Paul?
Yeah, if you could, just so that everybody else can see what people's backgrounds are on this call today. So vast majority of people are owning their own business, probably about 50-50 are VAT registered. Again, slightly more people don't employ staff. Majority have an accountant, which is good. A lot of them see the accountant more than once a year. That's actually really, really good in terms of an answer. Regular monthly account, again, 50-50. A lot of them use finance systems. So that's given me a good bit of background to who I'm speaking to. Because financial planning seems like a bit of a sort of mystic science to a lot of people, but really a lot of it's common sense. And I suppose that the next thing I'd want to go on is saying, like, what should we talk about today? Well, I think the remit that I've got is to identify some of the key areas that businesses need to consider just now, while we're in this unique state of lockdown, but in preparation of getting back to where things maybe used to be or the re-emerging economy. And that's quite a challenging thing to start planning for because of the levels of uncertainty. But also I want to touch on a bit of financial planning from a personal point of view as well, because I think there'll be a sort of a two-edged side to this. People are probably primarily interested in how the businesses are seeing it, but also from a personal point of view. So I suppose the first question you need to ask is, why do I need to plan? Why do I need to do a financial plan? And the flippant answer to that is, well, you probably don't. You might not need to, because a lot of businesses, in my experience, can go from year on year with no particular financial plan, other than perhaps an estimation or anticipate an aspiration of what profit they want to make in the next year. And that's fine to a point. But basically, it makes me think of the first quote there. If you fail to plan, you're planning to fail. Well, if you don't have a financial plan, you're not necessarily planning to fail, but you're certainly not planning to get the most and the best out of your business, because you haven't actually sat and thought about where you want the business to be and actually mapped out how you're going to get there. So the key thing with any financial plan is to remember that strategy always comes first. And I know that Phil did a webinar on the strategies of how your values, your missions, your plans in terms of the strategy. That's all crucial. That's always good to be done prior to actually doing any financial plans. And that takes me to that next quote: begin with the end in mind. Where do you want your business to be? And that's a difficult question for people to ask at the moment, because some people will think, well, I just want my business to survive, because, you know, where's my customers going to be after lockdown? And am I going to have a business? And those are really crucial questions to be asking. But also you need to think about, well, where do I want my business to take me? Because your business is generally a vehicle to supporting your lifestyle and your livelihood. So always start, before any financial plans, with establishing your business strategy, the aims and goals of that business, and begin with the end in mind. So if I move on to just say, well, what is a financial plan? Now, there's maybe a cliche quote from Warren Buffett that in the business world, the rear view mirror is always clearer than the windshield. And that basically, it's always going to be easier to look back over your historic records and how you've done as a business so far. It's much easier to look backwards than it is to look forwards. And it's increasingly difficult now because our historical performance might not be a reflection of what's to come, because the landscape may well have changed quite considerably during this unprecedented time with COVID. Is the market going to shift? Am I going to have the same customers? I'm going to have more customers. You know, if you were in the PPE manufacturing business at the moment, you might actually think, well, my market's going to go through the roof, because previously I just supplied hospitals and now I supply, care homes and potentially the public. So it's important to distinguish here between what is forecasting and what is planning. Now, forecasting is basically making an estimate of the future performance of your business based purely on what's happened in the past and some factual elements of the future, some reasonable assumptions that you can make. So let's say I take an example of that. Let's say you wanted to do a forecast of what your advertising spend was going to be for the full year. And you know, so far in this year, you've spent £5,000 coming up to the third quarter of your financial year. You know you've got one more advertising campaign to do. You know it's going to cost you £2,000. You can forecast with quite reasonable certainty that you're going to spend £7,000 by the end of that financial year on advertising. And that's a forecast that's based around past performance and pretty reasonable assumptions for the things to come. Whereas a plan, on the other hand, is an estimate that includes both what's happened and what you know in terms of facts, but also an aspiration as to how you see the future and what you think the future is going to hold. So there's a high level of uncertainty with plans. I kind of liken it to, let's say you were doing a weather forecast. Weather forecasting is something that isn't an exact science, but based on previous experience and all things being equal, you can forecast to a short period of time with relative certainty. The longer that forecast, the more uncertainty it becomes, and the less a forecast is relevant in the weather. But you can't plan the weather. You can't actually have an aspiration, I want it to be sunny tomorrow and I'm going to plan the weather. That just can't happen. But you can with your finances, because you have got a degree of control. So that's the thing that is also crucial when you think about financial planning, is what level of control have I got in actually creating this plan that's going to reflect my aspirations. So an example of a plan would be, let's say last year my business made £150,000 worth of sales, and I'm planning to increase that turnover by £30,000. So I know my planned sales for the next year are going to be 180,000. Now that plan will then create actions to make sure that you achieve that plan of £30,000 increase while maintaining the existing sales that you've also had. So a plan creates an action plan out of the sort of aspirational numbers. So just to recap on what I've said so far, financial plans, they're estimated. They require a level of assumptions. And nobody can make assumptions about your business better than you can, because you know the ins and outs of your industry probably better than anyone, or at least I would hope. And it's based on past performance, and it's aspirational. But here's the catch. Things have changed. Past performance at the moment may not be any reflection of future performance. And how does this affect the plans you make? And basically, what I would say is a lot of businesses at the moment need to plan as if they're basically startups again, as if they're actually setting up their business with a sort of level, with that level of uncertainty you might have had when you set up the business to start off with, and saying, well, how am I going to make sales, and what are those sales going to come from, and where they're going to appear from. So at the moment, businesses that are doing any sort of financial planning, once you've established how your market might have changed and how your strategy might have changed, need to actually approach it with a level of first principles, as if it was a new startup business. So how do you create one? How do you create a finance plan? So this is the science. This is the bit that everybody's been waiting for and thinking, right, okay, Paul's going to tell me how to do my financial plans for the next 5 years. Well, there's two ways you could do this. One, you could go and pay an accountant. You could actually sit down and say, I want to do a business plan. Can you help me? What's your fee going to be? And it's probably going to be quite expensive, because they're going to have to do a lot of discussions with you and talk about those assumptions that I've made and that I've told you about. But at the end of that, you'll have three key reports or plans or forecasts that you're producing. One is what you plan your profit and loss to be for the next whatever period of time. And I say whatever period of time because the longer you plan, the less reliable that plan is going to be. If you plan for the next 3 months, that's actually maybe quite a sturdy, robust plan built around pretty safe assumptions. If you plan for 12 months, there's going to be a higher level of uncertainty. And if you plan for 3 or 4 years, there's going to be even more uncertainty. So you can spend money on it and you can do it that way. And I wouldn't discourage people if they're needing that help. Alternatively, you can go on the internet and you can download a template. And here's one I prepared earlier. This is from a website called www.wenta.co.uk. And you're going to create a profit and loss, you're going to create a balance sheet, but fundamentally, most people are concerned about cash. There's a sort of a cliched saying in business that profit is vanity. Profit is sanity. Right. Turnover is vanity. Profit is sanity, but cash is the reality. And you really need to focus on what your forecast cash is going to be. And I would urge businesses at the moment that haven't already started doing that. I would think most businesses now that have been in lockdown for so long have actually got a bit of a handle on what cash they need to make sure that they can get to the end of the next month in terms of paying wages and stuff like that. So download a template like this, and I'm going to talk you through this template because it seems like, I know a lot of people, if they're faced with a table like this, some folk will bolt, like I know my good lady will look at this and she'll go, boxes and numbers and squares, don't understand it, and switch off. So I'm going to talk it through and try and make it as simple as possible for everybody. If you've got questions, please put them on the chat bar and we'll come back and have a general discussion at the end of what I'm talking about. So we downloaded this template, make it your own, is what I'd say. First of all, you want to take the template, and if you move on to the next slide, make it your own. Fill in your name, look at the columns and the headings and say, right, well, this is obviously a general template that I downloaded. Clydebank Widget Company is a limited company, so it's not going to have personal drawings and Class 2 national insurance, but it might have other costs that you think about. So make the template your own and actually own the numbers. And love your numbers. Don't be scared of them. That's what my coach is always telling me, love your numbers. The next thing you're going to start with your opening bank balance, because that's where you are at the moment. So at the bottom of this screen, the green there, you'll see this company's got £24,780, for those who can't read the slide, sitting in the bank account at the moment, and they're going to start pulling together a forecast or plan. I use those words interchangeable to a degree, but there is differences, as I've said. Okay. And then basically fill in the blanks. Now, that seems very flippant, Paul. Fill in the blanks, good grief, there must be more science to that. Well, there's a fair level of science to this, but realistically, it's based on past performance, as I've said. So it's based on what you know in terms of the experiences that you've had so far. So in this thing here, you'll see that you know that this director is paying £1,000 a month in director salaries. They know that their wages bill generally is £6,000. They've got a couple of admin staff that they pay £2,000 to, and they've gone through the last 3, 4, 5 months bank statements, and they said, right, what am I going to be spending each of these categories? And when you do that reflection over your past numbers, you'll pick up things that you think, all right, I've got that subscription that I need to think about, or I'm going to have to renew that sort of insurance policy in December, and populate the numbers based on what you know the numbers are at the moment. And that should take you a wee bit of time. At this stage, I'd say, don't forget government support. This company, after they've populated it, remember that they've gone and applied for a £50,000 bounce back loan. So they've popped that in because that's hit the bank account in May, just here. And they applied for a £10,000 grant from the government because they've got premises. That's reflected by the fact they've got rent going out. And they've popped that in there. And they've also furloughed their staff. So they're getting 4,800 plus 800 back from the government in furlough grants. And I was delighted to hear that the government grants, that furlough scheme has just been extended to October. For anyone that didn't realise that, it's just been announced today. So that would impact how this company would amend their plan. It might give them sort of scope to say, well, actually, we're going to be getting that grant for July, August, September now, when we weren't expecting it, depending on what they do with furlough. So make sure that you've applied for and accounted for all the government support that you can. Watch for things that require a certain element of timing. And things like that are your PAYE payments, your VAT payments. They might be quarterly, they might be monthly, they might, your corporation tax bill, that'll be 9 months after the year end, generally. So you have to think about factors as to the timing of it. So generally, when you're doing a finance plan, you think about the profit and loss account side of things, because that's in sort of absolute terms. And then you drill it into the cash flow to say, well, I'm going to have a time lag. For example, let's say this particular business has stopped basically manufacturing widgets while they've been in lockdown. And they're not thinking that they're going to start basically getting back into operation until August. So in this one, you would potentially have a bit of a time lag between buying materials and actually having to pay for them. So you may buy the materials in July, start the manufacturing to sell those in August, but not have to pay for the materials until August. So the point I'm trying to make is just be mindful of the timing that the cash is actually going to leave your bank account compared to when you're actually going to incur the cost, which might be before the actual money leaves. Okay. And then you come to the tricky bit, and this is a bit we could talk about for quite a while. And I'm actually going to ask if anyone's got any. I'm going to actually ask if anyone's got any questions just now. If they have, if they want to unmute themselves and fire in any questions on what I've said so far, because I'm actually managing to get through this material quite quick. Has anyone got any questions so far?
Either put your hands up physically so we can see you, or
I can't see you, so just unmute yourself and fire away. I'm going to take that everybody understands what I've said so far, which is amazing, because if Mary Ann's there, then I'll be gobsmacked if she's understood everything. No questions so far. Great, so that's good. So we've got the template. I'm going to talk about sales now, because this is a bit that actually is always in any business plan or forecast the most complicated and difficult thing to actually predict. And there's a simple reason for that. It's the one line in this template that you've got the least control over. You actually don't have a lot of control over how you make sales. You may spend money on marketing. You may have a sales team, but you're always going to be reliant on how willing your customers are to actually purchase your goods and services. So forecasting your sales is, without a doubt, the most complicated area on a forecast. The other line that I've highlighted here is what I would call direct variable costs, or material costs in this case. Direct variable costs are costs that are directly related to your sales, and they vary according to the sales. So in this case, you're going to spend more money on materials if you make more widgets and sell more widgets. It's just one of these things, but it's something that the relationship between that figure and your sales figure is direct, whereas the other ones are more fixed, and they don't really vary depending on whether your turnover's 25,000 a month, or whether it's nil. They will vary to a degree because you can lay staff off and you can stop some things that aren't necessary, but they're not as easily and they're not as directly related to the sales figure. So how do you predict your sales figure? Well, again, there's elements to this that you can basically look back at your previous sales and you can review which ones are relatively predictable. Now, talking from my own business experience, we have a number of streams of income. One of the more predictable streams of income is our rental income, because we obviously have tenants. And I say relatively predictable because obviously I don't know if one of the tenants is going to be made redundant and therefore not be able to pay the rent. So there's a level of unpredictability in that. But it's generally more predictable in other areas where perhaps when we're sourcing a property to an investor, that's much more project based, if I use that phrase, and it depends on the sort of events at the time. So they are much more difficult to predict than recurring revenues. So first of all, you want to split out your previous history of revenues. So let's take a different business. Let's say you sell refrigerators and maintenance contracts for them. So the sales of refrigerators will be dependent on demand at the time, but the maintenance contracts that you have sold in the past may be recurring revenue streams that you can predict with a reasonable level of certainty. So you want to split those things out first of all and map out on your plan what your predictable revenues are going to be. And then the next bit is basically having the best estimate as to the unpredictable things based on previous experience, demand for your products, and it's basically your forward order book. You might actually have an order book that you actually know that people are ordering things and that there is going to be a demand for those services and goods. So in this particular example that I've used, I've just made the assumption that the director of Clydebank Widget Company has thought, right, okay, we're locked down at the moment. Things are pretty much mothballed, but there's green shoots at the end of the tunnel. I think we should be able to get people back into the factory in July to start manufacturing widgets for sale in August. But historically, the business's turnover has been 25,000 a month. I think realistically, we'll be maybe sell half of that when we start getting back up and running in August. So the forecast and planned it to be £10,000. And that's gradually increased over the next few months back up to where they thought where they used to be in November. Now, that's just an assumption based on a hypothetical case study. It may be much more difficult to do that in your industry. I certainly think if you were in the hospitality industry, for example. Damon, are you asking a question?
It was just Michael Clerk had one that would probably be worth asking at this point because it relates to this. So we can bring Michael in at this point.
You made the point there about payment and forecasting payment, but right now small businesses are suffering significantly from late payment. So would you just kind of put a contingency in, or how would you deal with something like that?
Well, that is a very good point, because you're absolutely right. If a small business is reliant on being paid quickly, they need to put steps in their forecast to actually account for that. Now, that could be a case that, in this particular case, that they've maybe started selling in August, but they've delayed the actual receipt of the cash for 60, 90 days after that. And again, it's whether or not there's any correlation to what's happened in the past to actually what's going to happen in the future. I think putting in a provision to say, well, actually, we're going to do that work in August, but we're probably not going to get paid in October, is definitely forward thinking. And when you've actually started formulating your plan and getting the numbers onto a spreadsheet like this, you can actually start doing that sort of scenario planning, and I was going to come to that in a future slide.
Yeah, so just to clarify then, so if you're making this, start manufacturing in this hypothetical case in July, you then deliver the stuff in August. So looking at what you've got there, you're expecting, you call it sales, is that actual receiving payment or invoicing?
Yeah, no, it's a fair point, Michael. When I did this, you're absolutely right. I mean, this is, to be more scientific with this, you would actually have to work out what your sales, when the sales incurred and what the payment terms were going to be and whether it's going to be 60 days. So let's say in this one, I've assumed that they've been paid on delivery, for example, and they've actually received the cash when the sale's gone through in August. But in realistic terms, people may actually say, well, I want payment in advance. I'm not going to deliver your widgets until you've given me the cash, in which case that would stand. But if they're working on any sort of credit terms, then they'd have to factor that into the cash flow side of the forecast compared to the profit and loss forecast. The profit and loss would recognise the sale in the month that was incurred. The cash flow forecast would have that time delay as to when the cash actually hits the bank. And that's the significant difference between a cash flow forecast and a profit and loss forecast, is the timing of the events and when they actually hit the bank account. And that's actually a very good point and crucial when you're actually doing this forecast. So I've tried to do this as simplistic as I could, but that's a very good point. Damon?
So if I could just jump in there, because obviously with some of our other sessions, this has been a wee bit of a theme, and I would say that with past experience, 2008, we did see a big delay in payments. So that probably is a very practical point for businesses to almost scenario plan. I think it moved from, 30 days to 90 very quickly.
Yeah, and I think the initial thing is that a plan, like most financial reports, are there to inform the business owners to make informed decisions. If they know that the customers are going to delay payment, but they're going to receive the payment, then it gives them the option to make decisions as to, well, do I want to engage an invoice financing company to outsource the debts to, so that I can accelerate the cash into my bank account? That's a decision that they can then make based on the fact that when they do this plan, they can actually see, well, actually, no, I might make the sales in August, but those guys won't pay for 4 months. But they will pay. And that's based on previous experience. There's no reason why they won't pay.
That's a very, very valid point. And again, one of the discussions we've been having is people may be considering invoice finance. And also, I guess we should say to the people, there's a lot of businesses that aren't considering the loans that are available at the moment. But once you look at your cash flow, maybe that's something that would help you with late payments as well.
Yeah, absolutely. And for those businesses that might be on today that don't know what invoice financing is, there's certain people within the Chamber of Commerce that support that, like Bibby Finance, for example, is one of the members. And basically what they do is they basically buy your debt book off you, advance a certain amount of that debt to you. So let's say that debt was a £10,000 invoice that went out in August. They would take that 10,000 debt off you and maybe give you 80% of that up front, so you'd get 8,000 in August, and you'd know that. And you'd put that 8,000 in your cash flow forecast, but you'd have 10,000 in the profit and loss forecast. I'm just focusing on the cash today. And then they would give you the other 2,000 when that debt was collected, or whatever terms that you have with that invoice financing company. And that's a decision that directors could make, because obviously there's a cost involved in that. It's not as if they do it out the benefit, the kindness of their heart. There's always a cost to these things, but you can make an informed decision in the fact that I need to accelerate the receipt of my debts or my cash. So that's a good point. Is there any other questions on that so far, or does that all make sort of sense? Michael, does that answer your point? Or yep, great, okay. So moving on from that, and related to that is working out the timing when you're going to pay your suppliers, because correspondingly you might be waiting for 3 months to get paid from your customers, but you might be able to negotiate with your suppliers longer payment terms, and that's going to be reflected in that direct variable cost line of when you actually let the cash go out for your material costs that you're buying. So there's that sort of relationship between these figures, and that's maybe where discussions with your accountant and talking these things over with somebody who's familiar with the sort of financial planning means that you can actually think of those sort of nuances in the plan to make it as accurate and robust as possible. Okay, so we're cracking on with this. So now what? I've already kind of alluded to this. Now what, and what if? once you've got your plan populated and you know roughly where things are happening, there's a key question that you want to ask, and that is what if? And basically that leads you into what I would describe as scenario planning, and saying, well, what if we spend more money on Google ads and we increase this advertising and promotion line? Like, for example, the other question is why? Why are we still spending £250 in May, June, July on standing order for advertising and promotions when we're not going to make any sales on it? Is that something we can save money on? In which case you would cut that cost out or that cash out. But what if we spend more on it later on in the year? Will that increase our turnover higher? And it's that scenario planning that is really crucial. I mean, the information that you've got in the past, the stuff that you populate this plan with based on past performance, as Warren Buffett said, dead easy. It's always clearer. It's the what if scenario planning that's really where the jewels are in terms of planning. And not just that, what actually happens in terms of actions, because a plan is only, so good. You can do a really great plan and sit there and I've spent hours formulating my plan and then stick it in a drawer. Unless you actually turn it into actionable actions that you execute that plan, it's a waste of time. It's maybe quite cathartic in terms of where you are, but it needs to create actions. And the actions come out of what if scenario planning, and actually sitting there thinking about, well, what happens if we do that? What happens if we do this? So in this case, it could be, like I say, the advertising thing. It could be a case, well, what if we furlough staff for longer? Can we furlough staff? Are we going to get grants? And is there any other grant funding available? And that's really the crucial bit. So I quite like to open up again for any questions in terms of that sort of what if scenario planning aspect of the plan, if anyone's got any questions on that. I must be making things very clear.
I wouldn't mind jumping in myself, Paul, because so for instance, I sit on a board of the Linux Partnership, and they have a it's like when you're talking about the what if side of things. I think they produce 3 different sort of projections depending on so they can react to them. Is that common, or what's your thoughts on that? It tends to obviously be probably based on different scenarios.
Yeah, some people would put a sort of, you can have maybe a plan that's, and this is difficult because of the situation we're in at the moment where there's a level of uncertainty. And as I said, you're kind of planning as if you're a brand new business and you start from scratch. But you could have a sort of, well, if everything goes well sort of plan, and sort of status quo sort of business as usual sort of plan, or maybe a plan that's slightly more ambitious, and then a really stretch plan, saying like, okay, let's see if we can rack things up a lot quicker and a lot faster in terms of let's really stretch ourselves in terms of performance. So it is good to have those sort of different scenarios and say like, well, this is what will happen if we do this, but if we put effort into try and raise our turnover by 10%, it'll be like this. But if we try and double our turnover, this is what we'll have to plan to do, and that would be a stretch plan. So yeah, that's definitely a good thing to do, and I would say that if possible, do that. Be ambitious, but you also have to sort of think about, right, well, at the moment, what is my market for? Because I don't know what everybody's business is, but I know one thing: everybody's business will have been affected by what's happened in the past few months, and nobody's got a crystal ball, so it's very difficult to predict. So plans are really good. I like the sort of military sort of phrase that no plan survives first engagement with the enemy. You can plan to the heart's content, but your plan needs to be adaptable when you actually get there and we come out of lockdown. How's that plan going to adapt? If you haven't got a plan, then you're starting from scratch. If you've already got a plan, then at least you've got something you can adapt. So yeah, it's good to have different levels of planning in terms of how ambitious you are. Is there any other questions?
Yeah, sorry, me again.
For Michael.
I use a similar thing with my clients. What I see, most of them are very small businesses, some are actually very early years. And what I tell them to make sure is that when they've created their spreadsheet and they're actually reasonably confident that the numbers are realistic, obviously current circumstances kind of override that a little, but you look at the bottom line, and if it's going into quite a severe negative, obviously have to plan for that. But one of the things that I mentioned to him, I don't know if you want to cover this later on, is but you can actually use something like this to manage your overdraft facility with the bank to save you money.
Mm. Yeah. I wasn't going to cover that topic. Do you want to elaborate there, Michael?
Well, really, a lot of small businesses work with an overdraft. Whether they like it or not, this is how they are. And having an agent with the bank, and obviously the higher the overdraft, the more expensive it is for them. So if you can have a plan like this where you can forecast the spend, and as you said, if you could push out spend or pull in income to smooth out the peaks and troughs, it helps you to manage the overdraft and obviously save you money. Yeah. So cash flow planning is not just about managing the spend, it's managing savings as well.
Yeah, definitely. And I think that goes on. I mean, I was going to talk about this just while I'm talking about the what if scenario planning, is the sort of ongoing maintenance of your plan. As Michael's alluded there, that if you're reviewing your plan, and basically your plan starts off depending on how long you want your plan to be. It could be a 3-month plan, let's say. I'm going to plan the bank balance for the next 3 months. Depending on how close you are to the wire will depend on how often you review how the actual reality is progressing towards that plan. If you're quite close to the wire in terms of what, as Michael said, you've got an overdraft, you're probably going to be looking at that at maybe daily or even maybe twice daily, depending on when things have kind of come out. And if you can build into your plan, the plan that I actually use for our business, it's it's similar to this one. It's a wee bit adapted. It actually has the dates when things come out. Our regular costs, our direct debits, they're all dated. So I know exactly when that insurance policy is going to come out the bank account. And I know I check it on a day, 2 days at the most time as to, yeah, that's where I expect our bank balances to be to the actual forecast plan. And it's basically timed out to the dates of regular payments. And that means that I've got the decision for the discretionary items that come out of the bank. I can sort of say, well, I'm going to pay that supplier today because I've got cash and I know I'm okay for the rest of the month, or I'm expecting that guy to pay his bill by the end of the week, so I can delay paying that for another few days. And it just means that you're managing it. So you can either, it's great, as Michael said, from an overdraft management time, but it's also in days gone by when interest rates were actually slightly more favourable, you could maximise the income that you got from having money on deposit for as long as possible. That's not so much of a situation these days because you don't get much on deposit. Damon, you've got your hand up.
Yeah, it was just to hook into a couple of questions coming into the chat, I guess. John Doherty is more of a statement that kind of relates to what you're talking about and with scenarios as well as the next question, actually. So he's put an interesting, a valuable comment on cash flow plans. If the closing balance number turns negative, like sort of Michael had maybe mentioned, then you have a problem to deal with. So scenario planning can be interesting to see what a worst case scenario looks like, as well as your ambitious sort of target. So which also leads me on to, sort of links nicely with Linda's got a wee question. I'll maybe just let Linda ask this one, if we can unmute her, please. That's
Yeah,
Linda McBride.
Hi, Linda.
Hi, Paul. Great session, love it. You know, I'm a big advocate for love the numbers, but also was very good at helping other people with numbers, but not doing it in my own business. So it definitely resonates some of the points you're making. What I wondered was, in your experience, especially as well with the experience of working in NHS, is would you recommend planning for another pandemic? And if so, like what kind of contingencies can people make in their financial plans for things like that? Like, especially many businesses not necessarily.
Quick answer to that is absolutely yes.
Yeah, okay. Yep.
You could be planning for another pandemic. When I worked in the NHS and we did risk management, the scenarios that we were always planning for in terms of business continuity and disaster recovery were things like global flu pandemic, and what would we do if 50% of our staff were off sick, but the demand for our services doubled, and that's exactly what's happening just now. That is always on, and I think Michael did a really nice LinkedIn video on risk, managing risk in terms of a business. If you can actually identify some of the risks in advance, then you can put mitigating steps in place to either avoid that risk or at least know how you're going to deal with it when it comes along. So what I would say is, yes, plan for another pandemic, build up reserves now so that you are okay when that happens, because I'm pretty certain it will. I think we'll probably be more prepared for it the next time, but I think it's one of these things, whether it's a second wave of the current virus or a morph of a new virus, I think these are things that we've always got to have a plan for. And that's part of that's not just financial planning, that's risk management as well. What are the risks in my business in terms of if I couldn't work for 3 months, what happens? You know, so yeah, build up a reserve is what I would say in that. But that's easier said than done if you're managing a business and you're running basically at a break-even position most of the time. It's difficult to build up that reserve. And I think that's why some of the government assistance has actually been quite useful at the moment. Things like the bounce back loan. I know a lot of people who have slithered about whether they want to apply for something like a bounce back loan. But realistically, you can apply for that loan. You can have that on reserve just in case for a year, well, 11 months and 3 weeks, and then pay it back because you've not needed it. And it won't cost you anything. It will give you that sort of comfort to say, well, if this all happens again, at least I've got 20,000 to 30,000 on reserve just in case. So it's always good to do that, so that make sure you've got as much assistance as you can.
So it's thinking a little bit more strategically about that scenario plan.
Definitely.
Like I know a business owner who had a really bad fire, so that really affected their operations. So it's things building in worst case scenarios.
Yeah, that what if question. What if?
Yeah.
You know, from a personal front, what if I can't work for 6 months? How are my personal finances going to be affected by that? I know that Renata is on the call here, so she would probably be able to say, well, you can take out certain income protection insurances to make sure that risk is mitigated. This is a personal front. But what happens if my business can't operate for 6 months? What's going to happen? Well, I'm going to have to lay off those staff. I'm going to have to mothball that machinery. I'm going to have to try and get some grant funding or whatever. Or, you know, and a lot of things, that's what's happened at the moment, is that people haven't been doing that. Most small businesses don't plan like this. It's all fine corporate organisations like the NHS where it's inbuilt into their processes. But a lot of small businesses don't necessarily have those sort of plans in place, and it's crucial.
Yeah. Okay, thank you. Yep.
No problem. Thanks for the question. Anyone else? Or yeah, I'll move on because we're at 10 to 3 now. We've only got a couple more slides, and then we can just have a general discussion.
Hey, Paul, just very quickly, I just typed the question, but I thought I'll just shout out. So have you heard any news on the self-employed side for the sole traders? Because as you're saying, it's a good idea to apply for a low one and not to use it and then pay it back if you don't need it. I actually haven't thought of that, even though being financial advisor. But what do you think, will it have an impact if clients do want to remortgage or take any other credit? Because for the company, it's a company debt, but if you're a sole trader, it can impact. And then just talking to other advisors, we kind of didn't manage to agree completely, but most of the things says that it can affect. And I'm just looking, someone just posting, don't think it's reported to the credit reference agencies, but not sure 100%. Do you have any update?
I don't have any update on that as to whether it'll be reported on the credit agency. If you're a sole trader or a partnership, I would assume that it probably will be on a personal front. I think from my own knowledge of how mortgage companies operate, certainly in the investment field, they tend to focus on rolling credit streams like credit cards, and how much you have on that has a much higher level of impact on your credit score than, let's say, a personal loan that you're repaying. Which this would be. There are no payments on this loan for 12 months, so it's a case of that would be something that your circumstances may well have changed quite considerably in 12 months before you actually look to sort of take out a mortgage if it was that was the thing that was putting you off, and you could pay it back in advance and then leave it for a month or two till your credit score recovered. So I think that it's a good thing to consider. But there's obviously ways that you could probably mitigate any impact on your ability to borrow in the future.
Probably need to try and check that with the mortgage lenders and see what they will see, because possibly we will have different rules with different lenders, how they're going to take that into account, because sometimes sole traders can avoid some of the fees. But, well, thank you very much.
Yeah, no, that's fine. Great. Okay, so if there's no other questions, I'll just crack on with the slides. But like I said, I've only got a few left. So I'm going to sort of say, what's the next question? So what other things should I be thinking about then, Paul? I mean, right, okay, you've said, right, this is really quite easy. I thought it would cost me hundreds of pounds to pay my accountant to produce a cash flow statement. You said I can download it on the internet and fill it out for free, basically. And pretty much, yeah, tailor it, do it yourself. If you don't know how to use spreadsheets, then fair enough, I accept that. My other half is not a fan of spreadsheets, but she went on YouTube and spent a couple of hours learning about them on YouTube, and now she's a bit more au fait with spreadsheets. And the first thing I would say is love your numbers. And I know that there's a person on this call who will be smiling when I say that, and don't be afraid of them. And yes, as Linda said earlier on, review them regularly and actually work out what your plan is going to be, but work out what that plan is looking like based on the actuals and update it. What I tend to do with our cash flow forecast is I have it in columns as budgets, and it starts off as being all a plan, and then basically it turns into an actual column, and that reconciles to my actual bank account. And beside that is the forecast for that month. So I'm always forecasting where I want the bank balance to be by the end of that month. I'm planning what I want our bank balance to look like over the next 3 to 6 months, based on a sort of 12-month rolling sort of plan. As I've said before, don't be shy about taking government support. It's there to help us. It's actually crucial, I would say, for the economy that as much support is used, because if people have got bounce back loans and it's relatively cheap loans that they've bought, they may spend that money on a new piece of kit or supporting the business through the rough times, which means our economy is actually going to survive. Whereas if people are reluctant to take government support because they've got a fear of debt or something like that, then I personally think they're possibly shooting themselves in the foot. They should really try and take as much support as possible at this time. The main thing is getting through the here and now. So we all are quite focused on where we're at the moment and what our finances are looking like for the next month, 6 weeks, maybe 2 months. And that's crucial. So I would urge people, if you haven't already started looking at your finances, if you've kind of buried your head in your sand, which some people will do, and I'm pretty sure nobody on this call will have done that, but if anyone else is listening to the recording, start now, get on top of where you're at the moment. Review and schedule your fixed costs that your business has, the things that are non-variable, that basically are the standing orders, the rents, the rates, the commitments that your business have, and review your past income streams and your future ones for how predictable they're going to be going forward. And with the unpredictable ones, give your plan the best estimates you can. And then, as I said earlier on, how's your market going to change? And that's moving into sort of psychology really at this point, because you actually have to think, well, are my customers' habits going to change after lockdown? If I'm a landlord, for example, am I going to actually have less people renting my commercial properties because they now realise they can work from home? Or am I going to be selling more webcams because everybody's now using Zoom? Think about how your market's going to change and how people's habits are going to change. Is it going to be a case that after lockdown nobody's going to go to a restaurant? Maybe in the short term, but I'd be struggling to think that restaurants are doomed forever, because people's habits will ultimately return to normal eventually, and there'll be new habits and new products and new services that other people might desire after lockdown. I listened to an article actually where one of the companies that was in full capacity was making the wee metal strip that went around the nose guard on PPE masks. They were up to full production and had to bring on more staff because the demand for their products going up. So it's a case of thinking about how your market's going to change. And how will normality phase in for your business? Is it something that, great, the doors will open and everybody will be back up and running? Or is it going to be 3 months, 4 months, 5 months, 6 months? Is it going to be still like this in a 12-month period? And try and phase that into your plan. And once you've got the model, run the numbers. Think about scenarios. Think about what happens if this happens again in 3 months. What happens if this, that, and the next thing. and ultimately seek advice. You know, most of you said that you speak to your accountant more than once a year, which I was actually encouraged at, because a lot of people, they see their accountant as somebody who does their annual accounts and their corporation tax or their tax returns. They might see them quarterly if they do the VAT returns. They might see them more regularly if they've run their PYE. But they might not necessarily think about picking up the phone and saying, I'm trying to create a cash flow forecast for the next 6 months. Is there any way you could give me a hand? So I would actually say, please seek some advice from your professional advisors. And by all means, if you want to contact me, let me know. But I'm not going to be doing everybody's cash flow forecast. And on a personal front, we touched on some of these things. And moving from the business to a more sort of personal side of things, the same principles apply. I like to think about the Boy Scout motto: be prepared. If you're actually thinking about things in advance, then you're going to be in a much more solid state to deal with any of the traumas and things that happen. So again, in your personal finances, think about how you want the finances to pan out. Think about, you know, the here and now by all means, and what you need to do to make sure you can pay your rent, your mortgage, and all your critical expenses. So, but know them. Actually sit down and write them out on a bit of paper: mortgage, council tax, electricity, all the things that some people might never do. They might just be saying, "I don't have going to get to the end of the month," sort of thing. Well, write it down and actually make a personal cash flow forecast. And one of the things that on a personal front is budgeting, and I kind of liken it to losing weight. If you want to lose weight, there's different ways you can do it. You can just sort of get up in the morning and go, I'm going to lose weight, and you might lose weight, you might not. But if you actually have a plan, you sort of say, right, okay, I'm going to cut out this, I'm going to do that, I'm going to do that thing, and you record what you're eating. So you have a plan as to what you're going to, meals that you're going to make, and what you actually do. Then you're much more likely to lose weight quicker and more efficient than you would otherwise. But what I would also caveat that with is, just like losing weight, it seems simple, but it's not easy. Hence the reason I am overweight. Because if it was easy, everybody would do it. It's not easy. It's simple. It's a simple task. You just record what you spend, budget, and stick to the budget. You will save money. You will build up reserves. But it's not necessarily easy, because you'll get tempted, and humans are humans, and we just do that. So creating a personal cash flow and a personal budget, trying to manage that, will help you get your personal finances in a much better situation. Know what your personal assets and your liabilities are. Know what the sort of pension provisions you've got, your equity in your house if you own your own house, and what assets you've got, and also what debts you're paying: credit card bills, mortgage bills, HP, things like that. Just know them. Just know how much they are, how long they've got to go, how much you have to spend on them. And then you've got the ability to start thinking about, right, well, I want to pay down expensive debts. And as a property investor, I have no problems with debt. Absolutely. Debt is something that we build our business on. But that is all business debt. And that's what I would say is good debt. Commercial, your sort of consumer debt, credit cards, HP, things like that, I would call that bad debt. And it's usually very expensive. So if you can pay that down as quickly as possible, so that you're not actually paying significantly more for goods and services that you want, then that's another step on a personal financial front to do. And create that buffer fund that we talked about earlier on. Generally, I think, and Renata and the other IFAs that are on the line would be able to correct me, but generally, it's sort of good practice is trying to have 3 months reserve, 3 months cash in the bank, so that if this thing happens again, you know that you're going to have 3 months worth of money to be able to survive before you have to really start panicking. And again, on the personal financial front, if you are in any problems, seek advice. If you've got debt problems, citizens advice, and if you need any help, please don't bury your head in the sand. Take some advice, and there's lots of people out there that are willing to help for free. And that's basically all I'm going to say on financial planning. But I've absolutely open the questions to have a general discussion with everybody that's on the call.
Thanks very much, Paul. That was for. Do we round up afterwards of the importance? But obviously at this point, good if we can open it up to questions. I know we had, I think it was Katrina from Dandelion had a question. If you can unmute yourself, Katrina, and maybe ask that question.
Hi, yeah, I was asking about apps for forecasting or for future planning, because obviously you've got your Zero and things like that for your current things that link to what is actually happening, but I wondered if there's anything for the whole kind of thinking of the future. At the moment, I just kind of genuinely use Excel, and I have like coloured boxes of that I fill in, so therefore that I know that I'm increasing and things like that, so it's a visual representation of.
Okay. Do you use, can I ask, do you use Zero for your business?
No, I just use Excel for everything just now.
Ah, right, okay. Well, I mean, there are packages like Zero for your business that will both. The good thing about using a cloud-based system like Zero, and I'm not sure if there's any accountants on the call today, they'll keep, when I say accountants, practicing accountants at work in practice. The good thing about a cloud-based system like Zero is that it's all integrates with the sort of making tax digital side of things, so that you can actually use it very efficiently for doing things like your tax returns and your VAT returns if you're VAT registered. But they also have functionality within that system to actually be able to create budgets. So you can actually, in the system, say, right, I'm going to do a 12-month plan and actually map it out. And the good thing is, because you then start building up a database of historic transactions in it, it will help you create a more robust plan for the other things. Am I still with you guys? I think the screen just stopped sharing.
You spotlighted, so you're on fine.
Sorry, Paul, that was just me, so we could see everyone.
Ah, right, okay, right, okay. Right.
I'm wondering if there's anything like more fun, like you've got your Fitbit or you've got your diet plans that are little apps that are on your phone, and you go, oh, I've achieved, I've got to things like that are a bit more user-friendly, shall we say, than quite as dry as accounting.
Yeah, no, fair enough. That's a fair point, because I think, again, I use the sort of analogy of like dieting, for example. If you sit there and you've got a manual food record, you just don't do it. Whereas if you've got an app to scan your things, you're much more likely to actually put it in practice.
You said you were in there every day.
Well,
why would you look at your accounts every day?
Well, that's the thing. Why would you? You probably wouldn't. And the thing is, a lot of people, they don't look at their accounts every day when times are good, because they're comfortable, they've got reserves, things are going fine. But when things start becoming more critical, that's when they start looking at their finances on a more regular basis. And I think really the tools are not the focus. The habits that are the focus. It's the habit of actually planning what you want, what your finances to look like, and recording what you're doing and comparing the two is a much more important. So if you can find I don't know any apps off the top of my head which are but I'm sure if you go in the App Store, you'll find some that you can experiment with. Damon?
Well, just to jump in, because I think we touched on something there, which is the online sort of accountancy and bookkeeping. So I did notice 30% of the businesses aren't doing that. That is life changing. And actually, Katrina, when you were talking about it, actually, to be honest, sometimes I found myself sort of getting a wee bit, because it was so user friendly. And I think Anne's just put up about QuickBooks. So I think there's obvious ones: Xero, Cashflow, QuickBooks. And we were talking before about, I think RBS offer I've heard good reports about Free Agent as well, that they offer free with RBS account. And it does help you because they're so easy, and they're not like, I think when you're faced with a complex spreadsheet, it is a turn off. Whereas these things, you've got a wee app on your phone for your expenses and your scan thing. They're not quite, like a sort of step tracker, but they're so easy and so intuitive, and zapping your expenses doesn't become a headache anymore. So
I think, unfortunately, though, the finances, for some folk, it is just one of these things that they just will really struggle to get interested in. I have to say, and that's fine, because everybody's different. But I think if you've got as a business owner, you have got a bit of a duty to be interested in it, because you've got that responsibility as running a business to the people that you either employ, or to the authorities that you account for your tax and things. So there's a level of that. Damon?
Just to jump in, so I don't know if your wife's going to disagree with you there, but she seems to, Mary Ann seems to have her hand up there. So
laughing at the bottom of my screen. What's she going to say?
Well, what can I say when I've been brought into this conversation number of times in your presentation? But I think it's First of all, I went and married an accountant to get over my challenges with finance. So that was maybe the most radical thing to do.
That's the only reason you married him. No. The truth is out now.
Marianne, I don't think that option's open to everyone.
Well, my one's taken, but on a serious point, I would never, I'm not wired to be excited by spreadsheets the way that Paul or John Docherty on this call is. And I never will be. And I waited for a long time to find that motivation. I was waiting on myself, waking up one day and it being there. But the reality is, for me, I was never going to be motivated to get into an Excel sheet or start a cloud-based system. And it took a lot of effort and understanding the value that actually being in control and having that understanding of my finances brought. And when I reflect back, there was a lot of fear, actually, years back, at being able to really understand my financial position, because deep inside I knew that maybe not all of it was good. And I was also scared that I wouldn't be able to understand some of it. And at the time, I maybe didn't have the people around me to help me to understand it. So it's connecting with those things, understanding the value of it, especially in relation to building your business. You have to be data-driven with your business, and really, and this crisis has proven that. To accept that you might not ever feel motivated to do it until you actually push yourself, as Paul says, into making it into a habit. And as someone now who loves Xero, still doesn't like spreadsheets, I have to say. Sorry, John. I don't think I'll ever get my head around that, but going to a cloud-based system, Katrina, was really empowering because it brought it to life in a way that helped me to engage and really feel in control of my business, even when the times are hard. So he did his job well.
I'm just having a quick glance through the chat while you're speaking there, and picking up on some of the points that some of asked, it's mentioned earlier on, and John Docherty did. I now read his point. John, do you want to come in and talk about that in terms of the negative balance? Because that's something I didn't touch on, but it's quite crucial on a cash flow forecast to really watch that.
No, it's fine. Michael covered it already. It's just if you are doing it in a spreadsheet or any other tool, those numbers should turn red anyway, and it should catch your eye. But it then lets you play around with lots of different what if scenarios. Like, what if no one pays for 3 months? What happens if 50% of people default? You know, real disaster scenarios. But when you're using these things as a model, then sure, model the worst case. Just on the thing about turning people onto numbers. I mean, I found myself that when I bought my first house, I'd gone from being a student where I had no money to being a company director where for some reason I still had no money, and it was putting a spreadsheet together. You'll be pleased to hear. Helped me get a grasp on that, but I didn't have an interest in it. But I did it out of sheer bloody mindedness, and it was actually I started watching a lot of Martin Lewis personal finance videos, and that kind of really switched me on to the idea of really getting my personal finances, stuff I was doing for business and things I was advising clients on, but I just wasn't applying it myself.
No.
So even when you think you know this stuff, you don't always apply it. And when you do, geez, what a difference it makes.
Yeah, I mean, common sense is not always common practice. That's the thing, isn't it? And a lot of the stuff that we're talking about today is really just common sense in terms of mapping out that plan, but it's not always common practice. So thanks for that. Yeah, I think we've touched on the comments about apps. Damon?
Yeah, I just wanted to bring Russell in. He had his hand up there. So,
do I have to
You're fine, Russell. Oh,
is that it? Am I unmuted? You hear me?
Yeah.
It was just that I'd made. I didn't want to interject earlier on as you were going through the slides and whatever. I just made a few notes as we were going through. It might be helpful. I mean, the first one, obviously, on cash flow. I in my experience in even tenants who come to us and a new business, and this is what we're going to do. There's my impression is always a temptation to be over optimistic about a new business or your plans that you're excited about, and almost develop the cash flow to suit your desired outcomes. I think that's a temptation you need to be careful about, you know, if you do your cash flow and it comes out all negative along the bottom line, you think, oh no, well maybe I'll sell a bit more, or you know, maybe I can get away with, you know, fewer costs, and my experience generally that your first plan was usually closer to the to reality. But just in terms of at the moment with people and small businesses, whatever, being a commercial landlord, we get, you know, we're dealing with a lot of different types of businesses, and not just at the moment, but at other times, folk get into difficulties, or things are tight, might even be seasonal. My advice is always to speak to somebody. Don't wait until it's an issue or it's a problem. Speak to your landlord, even your bank. You know, the last thing is, well, what they want to know is what's happening. Just when you go quiet and bills are not paid, or your overdraft is suddenly running up, and nobody hears from you, and they'll assume the worst. If you speak to somebody and satisfy them, or at least giving them the confidence that you're dealing with it and they likely to get paid. If you can't afford to pay a whole bill, offer something towards it. Say, you know, can we pay you £200 just now, and you know, the other 800 we'll pay every fortnight or something. People are always happy to come to some sort of arrangement and payment plan if you speak to them. Generally, some people maybe are unreasonable, but I think most people are reasonable and would do that. There's utilities. You could be on a variable plan where suddenly 1 month in the winter, you know, your costs go up, and in the summer it's down. The alternative is that, you know, we have a fixed budget sort of plan where, you know, you've got a fixed amount every month. I was just thinking that when you have your spreadsheet going across, if you know your electricity is £89 a month every month, you can plan maybe a wee bit more easily for that.
Definitely, yeah.
I view debt as something you buy things with, assets, property, stock. You know, if you're going into debt for day-to-day expenses, and that kind of worry for me. I mean, I've seen a tenant who was buying stock on personal credit cards and not paying it off, and once you get to that stage, you're kind of in trouble. And certainly, if you've got the float you were talking about, if you know you've got capacity, then you don't need to be checking this in minute detail every day. But if you're near the break even, and then you do need to be looking at every cost on a daily basis. Looking, and there's no excuse. You can log into your bank account from your phone or online. You know, every day. You can do it twice a day, just checking if what's come in, what's gone out. So you do need to look at it more closely if you're working closer to the bone. And just finally, I know I've rambled on a bit, but I'm a civil engineer by training. I remember our first site as a water treatment plant, and my first job as a site agent. The senior engineer had come down from head office and spent all day with me with the lever arch folders of all the project plans, the costings, the bills of quantities, and whatever. And as he was folding everything up and putting it in boxes to take away with him at the end of the day, he leaned across the desk to me and he said, "But we've talked about a lot of plans, about the engineering, about everything." He says, "But just remember, we're a business. We're still a business, and it's all about the money." And I only remember that because it was a hard lesson, because I did let the money get away from me, and I don't think they made any money on that job. Mainly because you can get tied up in feeling that you have to do things when if you can't afford to, you can't afford to, and that's the bottom line.
Yep.
Yeah, no, I mean, you brought up a lot of good points there, Russell. I mean, the first one in terms of that optimism bias that you have when you're doing a business plan, that was something we always had to take account for when we're doing plans in the NHS, was how optimistic are we being with this business case that we're producing. And that's something that you do need to take a level of degree in terms of your forecasting. And also basically what you've explained there is just basically, once you've got that plan, go through it line by line. What can you do about that cost? What can you do about that cost? Is the timing right? Is the amount right? And basically you can really refine that plan so that it's a meaningful tool, and then use it on a daily, weekly, or how often you need it. Damon.
Okay, yeah, I think we had Tim wanting to ask a question there.
Okay.
So if we can unmute Tim. Sorry, Tim, can't hear you.
There we go. That better?
Right, yeah, perfect.
Sorry. So back to Kat's point. So the cloud-based system has been a savior for me. So I find Receipt Bank a very, very stress-relieving tool. You snap the expenses, and it then calculates the currency, it calculates what it reads the receipt to where it goes, and it links into Xero very nicely. So it basically takes everything out of the equation, and I feel good every time I take a picture of the expenses, because there's no papers that have stacked up that I've got to do over and over again. So that's a really good one. And then on to what Paul was saying about checking every day. I'm very similar to Marianne on this, is that I hate spreadsheets. I'm an anti-spreadsheet person. Anything that comes spreadsheets, I go to my wife for and get her to fix all the code problems that I've got. So I've got a very optimistic view of things that, okay, I've sorted it out and everything will be fine. So it takes a lot for me to come in and update things regularly and check things regularly. How often should we be looking to keep a check on these things, adjusting it, updating the forecast? Because you don't, obviously, doing it too much, you end up not really doing anything, but doing it not enough. If you wait 6 months, then 6 months, a lot can change in 6 months. So what's a good time frame to be looking to update this and keeping track on it?
There's no definitive best time. It really is down to each individual and each individual business. What I would say is, though, if you are in a financial challenging position where you may tip into overdraft unexpectedly, then you'll be wanting to check that on a regular basis, daily or every other day. If you've got a bit of reserve and you know that your plan's fairly established, then you might want to check it once a week. I would say you want to probably not leave it much longer than that, because you should really be checking your bank for erroneous transactions on a regular basis, because the last thing you want to do is look at your bank account and realise that you've double paid something, or somebody's taken something at your account that you weren't aware of, or you've had a standing order coming off for 3 months that you thought you'd cancelled, things like that. So if you're not checking your bank balance on a regular basis and comparing that to your plan and saying, well, what's going on there, then you're likely in a wee bit of a cleanup time situation. And I'm not saying that's not something that, you know, everybody does that, I think, to a degree, unless you're incredibly disciplined. But the more regular that you check it, the more quickly you're going to be able to take rectifying action on that. So
great, lovely. Okay, thank you. Yeah,
cool. That's
Michael, you want to come in?
Yes, sir. I'm just thinking myself, just to give someone a practical example, so they know just how valuable this can be. Someone I was working with was doing really well, but not making as much money as anticipated. What we found out was, we looked at his material expenses were way above what they should have been. And what we discovered was that each of his staff members was having their own little stock of materials, and he had a warehouse with stock of materials. So we decided one morning that he would do a stock check, and on Monday morning, beginning of the week, do a stock check, see what we've got. And they realised that we totally lost control of what had been purchased, and we stopped all purchases for 3 months. So it was 3 months worth of money back in the bank that he hadn't expected, simply because he wasn't looking at his cash flow often enough, managing the expenses. So that's a real example of the value of doing this and the benefit it can bring.
Yeah, definitely. That is a great example of managing it. I remember having a client, and there's another element to that in terms of making sure that the margin is right on the sales that you're getting, and between the expenses that you're paying and the revenue you're expecting to get from that. I had a client who was a bakery business, and they had 16 stores main baker, 16 outlets. And the managing director, and this is going back into the early 90s, so it was before we had cloud-based systems and all that stuff. It was basically old-style computing reports, but had that sort of thing laid out, and he could basically pinpoint any store where one of the managers was, taking out the till based on the variation in that margin. So, and he did that on a weekly basis because he was checking those numbers on a weekly basis. And that's why I say, love your numbers. They are your business in a picture sort of thing. And I know I'm maybe never going to convince Marianne to love her numbers, but she's starting to at least see the benefit of it. Damon.
We'll have to round up soon. I'd like to jump in as well in terms of I'm similar to a few of you here who just not into the whole sort of spreadsheets and finance, but I think the having the really easy to use tools, and just to talk about, so you do get a wee bit, once they're easy, and it's not saying it's quite like playing a game, but you do get once you've got your numbers in, you can get a wee bit obsessed with it once you've got over that barrier. But what I was going to say as well was, when I was first starting out, first had the cloud-based accountancy, actually a really interesting thing was what you think is going to sometimes be your where you're going to make your money. You have a look at these where you're actually making the money. So I think for a good example was I started out in PR, for instance, and I just didn't get any business PR, and I got a lot early on. I ran a marketing agency, and early on I was discovered back when the print was very big part of most businesses, and I was making loads more money, sort of just doing print management than I was, trying to pump PR. So I changed my emphasis in terms of the amount of time that I spent and the business development side of things. So even as someone who wasn't really into these things, it really helps you make good business decisions, and it kind of leads me on to a wee bit of a roundup as well in terms of how important planning is. We're really pushing this at the moment because it can be the success or the failure of a business in terms of good planning, and in terms of the I guess one thing to talk about, people are talking about different ranges there. So it's the worst case scenario, Russell's right. But also, you have to be ambitious, and having the things to aim for on the top line. Just don't base all your business on that ambitious line. But what a feeling if you actually achieve that at the end of the year, for instance. And I think in terms of the other thing is, it's not set in stone. These are organic. The whole point of forecasts is to measure them against performance and rejig things as and when you need to, and that's the way that successful businesses run. There's a really good example of someone was telling me about how just talked about being data driven there. I think Marianne mentioned that. Someone told me about how supermarkets actually on an hourly basis, I think Coca-Cola can track how much they're selling in one store and get in touch with the store to move. If they're not selling enough, they've got a deal whereby the stock gets moved to the end of a higher profile point. So that's hour to hour they're operating on. So it's a really valuable lesson. And I know, like myself, some people have a resistance into it, but if you embrace it, get these tools that are out there that are just fantastic for managing expenses and online accountancy and bookkeeping. It can be a real sort of asset to your business. So before I finish up, Paul, do you want to say any more?
No, I think you're saying a lot there. I mean, I would use the acronym KISS, keep it super simple. Because if it's too complicated and too convoluted in terms of the science or the numbers or the formulas that you use, then it's just going to cause you to disengage. So keep it as simple as possible, but without losing too much of the benefit and the meaning of the projection. And then you'll have a pretty robust plan that will inform your decisions, and ultimately that's what they're there for.
Great, and it is one of the themes we talk about in all of the sessions that we've run, is how the landscape and we coming out of this is never going to be the same again. and this will force people into using sort of new technologies and embracing these. So there are some, we're always looking for the positives of this. So there are some things like this session that can hopefully push people down the right route to be a sort of resilient and robust business going forward.
The only other thing I would add is the time frame as well, is that don't try and plan too far in advance, because like I said earlier on, it becomes less meaningful the longer the plan is. A good increment is 90-day installments, and that's certainly why I know that Marianne does 90-day coaching installments. 90 days is a good time to be able to create a plan that's meaningful and give you enough time to actually put in meaningful actions to get a result, but not so long that it's going to become meaningless or too sort of away on the horizon for you to do it. So by all means, have a 12-month high-level plan, but break it down into maybe quarterly installments that you really are focusing on.
Great, fantastic. So I know we're sort of almost out of time now, but I must mention some. Well, firstly, to thank Paul for a really brilliant, in-depth presentation. And can you believe that was an hour and a half of finance, and we're all still here.
We started off over 20, we're down to 17, so I didn't lose too many people. So.
Aye, but they were in accountants going off to
to
deal with clients. Yeah. So no, thank you so much for that. I think it's so much valuable information in there. And as I said, we'll be recording this, putting it up. We'll be hopefully adding some of the slides, Paul, if you can provide those. And just a reminder, if you click the 3 dots in the chat, you can actually save the chat for all the contacts and links that have been put up there as well. And I better give a quick plug. So one of the things we touched on there was personal finance. So I know that Renata is going to be putting together a wee presentation, so that'll be a really good follow-up to this in the next few weeks, hopefully, along with her colleague from St. James, so we can sort of fill that gap in terms of personal finance. Other things I need to mention as part of Together for Business, we're starting up a weekly surgery. So we've got 2 things. We've got a weekly networking session, which is going to be Tuesdays at 9:30, just to keep businesses connected to now that we are re-emerging, to try and sort of, look at doing business together, to look at sharing how they've are managing to develop their business and bring them out of this crisis. So that'll be on Tuesday. On a Thursday, we have we're aware that we're shifting from the advice side of things a bit in terms of our forums that we were running, but we're really keen to give a platform for businesses to connect with some of our experts on a Thursday. So join us this Thursday. You'll see on the events page, and we'll share that in terms of dropping in. And I think we've got actually Michael from the council is going to come in. So if anyone has any questions about funding and the business support from the council, one of the managers from economic development is going to be joining us for that. And we'll try and get a few of the other experts to join us to see if there's any other questions that businesses have. And finally, again, sort of continuing the theme here, Marianne's kindly agreed to do a pivoting with purpose, I think it's called, next Wednesday at 2. I think what we're going to try and do is Tuesdays at 2, we're going to try and introduce these weekly webinars, which is our knowledge transfer. And we don't think, once a week is probably a good number, so that we're not sort of, I know people are a bit overloaded with Zoom these days. So we thought once a week would be a really good way of sort of just distilling some of that information. So I don't know if you want to just come in, Marianne, and give us 30 seconds on sort of what you're planning next week.
Yep, I think, Damon, there's been a lot of chat around planning. We've had financial planning today, and about not looking too far ahead. And there's also the term pivoting is being used all over social media at the moment. But actually staying connected to the reason you're in business is really important and helps to make purposeful, informed decisions about how to pivot in business. And the session next Wednesday is hopefully going to be an interactive one. So everybody will be getting asked to bring their pads and their pencils. Do we still use pads and pencils? I like pads and pencils. Yeah. Pens and paper, pads and pencils, and we'll be doing a bit more of a workshop and going into small groups and trying to connect with our purpose so that we can pivot in an informed way. Is that a good enough pitch?
Yeah, no, brilliant.
What do you
Thank you very
think, John
much. Thank you very much for summing up there. So lots going on. Please do stay connected. Support the Together for Business initiative. The more people that know about this, the better it is for helping more businesses come out of it in a better position. And you know, please do share on our social media and follow us on. I think there's a hashtag Together for Business, and you can follow that on LinkedIn and Twitter to share anything that you can to get us the profile. And then just before we finish, we normally have a Philip, just for social media purposes, gets a wee screenshot of everyone, so we could have a wee smile slash thumbs up now.
Start straight, everyone. Right, 3,
Okay.
2, 1. Thanks very much.
Brilliant, thank you very much. So thanks again to Paul, and thank you everyone for taking part in today's session. Thank you.
Thanks, everybody.
Bye. Bye. Everyone.
Hey,